Okay, welcome everybody to the October 2025 WITI LinkSV session. Where did the money go? I call it, Don, but I know it's the technology, talent, and investment trends, which we're going to learn about. Everything's moving at AI speed this year, maybe quantum speed next year. And this will seem like nothing, right?
Well, I tell you, if it does, David, it's going to be something else. This has been a crazy year, and it seems to be getting even crazier. Let's see here. All right. Yes, I'm still learning to use Gamma, so bear with me, folks.
It's looking good.
All right. So, yes, September. We came back from summer, and boy, did we have a September. Let's start with the amount of money that came out in September because that was mind-boggling. 34 billion. That is short of OpenAI's 40 billion raise early this year. That is the largest month we've seen in since 2021. We had one that came close. But that 34 billion in September takes us year to date to 156 billion. We've already exceeded the total funding that was brought in the year of 21, which was the year in which zero interest rates ruled. Money came in from areas, private equity, high net worth individuals, pension funds, you name it. Everyone wanted to get on VC in 2021. But since 2021, things slowed down. We hit our low in 2023, came back up a little bit in 2024, and man, we're going on all batteries now, 156 billion, and we still have, of course, a quarter to go. Now, most of what I talk about today is not the 3/4 details because we're so close to the end of the third quarter, we haven't pulled all the figures together yet. We'll have a little bit more on that next month, but starting from here, so that 34 billion, now not surprisingly, broke down into mostly AI. The 26, almost 27 billion of it was AI. And when I say AI, it's AI infrastructure, which encompasses the frontier model companies, the software around LLMs, anything that goes to pure, I call it pure play AI, and that is anything that's not vertically oriented. So that includes data centers, that includes different types of power generation. Um, it is everything that contributes to the sector's growth. And out of that 2698, we started off the month with a big 13 billion into Anthropic. And XAI followed up with another, I think it was 10 billion, but an amazing number of not just mega deals, which typically 100 million or more. We saw a lot of those in 2021, but these are deals of not just 150 billion either, or million either. It's 100, 200 million, it's 750 million. Very large deals going to single companies in single rounds. We saw little bits, and I say little bits, these are all billion-dollar segments, but again, compared to what there is in AI, they're not that much. What's interesting here is software, which encompasses most of the horizontal applied AI. And when I say applied AI, it's AI in applications that go to in software, typically enterprise. Of course, we're seeing applied AI in all the other sectors as well. So we see fintech, we see prop tech, legal, We'll get into that a little bit more, but all of these segments exceeded $1 billion. This is an interesting one because semiconductors, computers, these could logically, many of them, be grouped with AI infrastructure. Of course, the heavy load that AI places on the processing system means that we have had companies, and still do have companies, looking at every inch of that processing funnel and just determining where they can make it better. So it's in the chips, it's in the memory, it's in the communications, the networking. There are a bevy of startups that are focusing in that arena. And that takes us again to applied AI. So you can remember back when ChatGPT came out and a lot of software developers jumped on it. They wrapped ChatGPT in a little bit of a vertical wrapper and put it out there and did some really fast growth. In 23, we saw assistance, or a focus primarily on assistance, not autonomous. You get something started, they'll finish it. And of course, 24 in this year, it's all about agentic AI. It is autonomous agents that can make decisions, can take multiple actions, can complete whatever needs to be done in a given process. Now, we're seeing agentic AI in, when I say mature, I simply mean that it has been put out, it has been tested, it has been adopted, it has gone enterprise. Customer service, legal, coding, those are probably the first three that we saw in great depth. And they continue to dominate. You have a company like Harvey that pulled in 350 million for legal, customer service at different levels, both help desk as well as voice communications. And it continues to be well funded. And of course, then the horizontal, the enterprise. This is, I'm not going to say generic because it's generally customized in some way to the particular company, but it is internal workflows. It's making things faster, better, easier. And again, as we move towards the agentic, it's taking things out of people's hands and getting them done without human intervention in many of the cases. An interesting sidebar, depending on who you're hearing from, this is either taking off in great amounts of adoption, being very successful, replacing people. Most of what we hear on that tends to be out here. Other parts of the country, we're seeing surveys, opinions, reports that talk about a plethora of unsuccessful pilots. And of course, till you get a successful pilot, you're not going to go much further. So this continues to be an area that we're going to see continued adoption, albeit slow in some places. So if we look back over the last 4 years and we look at the percentage of funding that has gone to AI, and AI infrastructure in this case is what I'm referring to. Back in 22, we were not tracking AI as a separate sector, so can't be sure. But since then, it has been steadily increasing. You know, this year, as of right now, 70%, 78% of what we've recorded has gone to AI infrastructure companies. And that goes up and down. You know, you get 13 billion from Anthropic, and all of a sudden the percent is up a little. That may decrease some, but we have hovered between 70 and 70 some percent all year and for the last half of last year. And just so you're aware, it isn't just here. AI across the US is taking the lion's share of funding. Now, this figures are from PitchBook. What they record is in 2025, 64% of the funding has gone to AI companies, and 36% by numbers, by deal count, to AI companies. We're heavier here. San Francisco, San Jose, Silicon Valley is a hotbed of AI activity, and as a result, many of the huge deals, OpenAI's 40 billion, it happens here, and that skews our percentage significantly up. David, please stop me if we have any questions that I can amplify on.
I sure will. And if anybody has questions, feel free to raise your hand or type them in the chat.
So it's an interesting
Oh,
overview.
wait, before you get going again. Hey, Chris, great to see you.
Thank you so much, David. Hi, Don. Thank you very much for putting this all together. I didn't get to read in depth on this, but I saw this morning somebody talking about we are seeing right now with all this investment going in very much a sort of a circle form of economics and investment that is inflating the bubble in the same way that a lot of those new media companies traded advertising, spent money and what have you, and created the bubble that ended up blowing up in '99, right? What do you think of that with regards to now when you're looking at the money flows? Is it actually going to value, or is it really going to the incinerator in many ways and not creating value?
That's a really good question. Of course, the demands of AI in terms of power and just computer consumption are off the charts compared to any other sector we've tracked before. So by dint of that, we're going to see more larger rounds going to the companies. Now, does that create added value? I tend to come down on the side of we're either starting to see or we're in a bubble. When we look at valuations, as a matter of fact, note here, OpenAI just did a secondary sale for their company, for their employees. That just gives employees a chance to take some cash out, get some liquidity, so they are not so head up on having an IPO. The valuation for OpenAI for this round was 500 billion. And they had oversubscribed. There were more investors waiting to buy those employee shares than they had employee shares to go around. And that's not a little. They said they'd offer up to 10 billion, and there was only 6.6 billion offered by employees. So I think we're starting to see a bubble. I think that it becomes really difficult to evaluate because many of the rounds do involve not cash on the barrel, not investment money, but cloud computing. And we'll get to NVIDIA in a little while. Chips, some form of access to computing and power. So we'll talk a little bit more about that, Chris, but that's my thoughts for now. Looking at valuations, which actually goes to this and to the bubble, it's really two sides of the river here. If you're an AI company, you likely have a good valuation. When I say good, no, let's not use the word good. You have a valuation that is substantially higher than you would have if you were not an AI company. And this all gets built up because we have the high valuations coming in for frontier model companies. It increases pressure across the board. As investors want in, the more investors, the likelier it is for the valuation to be pushed up. So we have a plethora of investors wanting in on AI deals. I'm not going to say we're in FOMO yet, fear of missing out, but there are a lot of indications that feel a lot like 2021 when we just had money going in where due diligence was missing. So anyways, two sides of the river. AI companies valuations are up and they continue to slowly increase, and that is at, I think, yeah, at every single stage. So seed, Series A, Series B, and so on. Now, companies that are not AI based, and I say this even though everyone has AI in some form at this point, but those companies' valuations are down. So 2025, almost 25% of the rounds have had valuations that are less than or equal to their previous round. That's not a good thing. That makes it hard to get investors in. And taking that a little bit further, 16% of the cash raised have been bridge or extension rounds, according to Carta. Bridge or extension, you get a bridge or an extension when you haven't made enough progress to justify a new valuation and a new series. So that's saying that a lot of these companies are simply not making the progress that they need. And part of that may be just absolute progress. They just haven't gone far enough, fast enough. But on the other side, it's relative. When there are more attractive deals out there, a company may find it difficult to raise that new series, and they may have to resort to persuading existing investors to assist them on a bridge round. Maybe bring in one or two new investors to make it an extension. But not, in general, not.
I mean, could it be now, Don, that because they're able to use AI and maximize people, it may not need as much of the human capital as they did when they had prior rounds, just depending on where they are?
Well, that's possible, but that still doesn't, that wouldn't be a reason to do a bridge or a extension. A bridge or an extension is
Right,
just
but I was
flat
just
out.
talking about raising less.
Oh, okay, yeah. Well, possible, have not really seen that. The size of rounds keeps going up.
Got it.
Of course, companies that don't need the computing power, as you say, David, don't need to raise as much. If they're using their own models, if they're using small models, all the more good for them.
Right.
Now, we're also seeing a lot of companies turn to venture debt. Venture debt, the amount of venture debt picked up has increased in 2025 over 2024. And by the way, venture debt is really only going to be used by companies that are doing well, because the venture debt lenders want to get their money back. They're going to charge a fairly good percentage on the money. And if you aren't having a real strong balance sheet, if you're not profitable, doing well, or can't make a real clear case that convinces them that you're right next to that turnaround, you're not going to get venture debt. So that's 2025 valuations. Don't expect to see a change in the trend of slow but steady increase for AI companies. And this is an interesting phenomenon we've seen increasing over the last couple of months. Our frontier model companies, I said they're pure play AI, they make the frontier models, but increasingly we're seeing them jump into verticals and horizontals and competing with their own customers. Yeah. They've got huge valuations. Those valuations demand that they create revenue. And applied AI is for them, apparently, the quickest and easiest way to get there. So you have OpenAI announcing that they're going to create a job site that is by their definition, superior to LinkedIn for finding jobs, finding employees. It's going to use AI in ways that simply haven't been possible before. 2026 launch. Anthropic, you read their press announcements, they highlight that their Claude models do a better job of coding, programming, than anything else out there. And in fact, if you look at the coding startups, most of them use, or at least offer an option to use Claude. So they're charging their customers, but they're paying Anthropic. And by most of what we hear, by all of what we hear, none of them are making money. They're all losing money. Losing more money, the more business they get in the coding arena. So another reason for the big rounds for those folks. They have to keep putting money into what just costs them more. Thinking machines went in the same direction, competing with a few companies that are allowing you to choose, route, and calibrate your models without being a developer, a programmer. So we're just going to see more of this. And if I were in an applied AI company, I would be worried. I would certainly be looking to the future to figure out how I can protect myself, create a moat around my company, for future incursions by the OpenAIs, the Anthropics, the thinking machines, the safe superintelligence, all of their ilk. I had hoped to put together a list on this. I didn't have time to do it. I can tell you that acquisitions in the Valley have taken a real uptick. We've now seen more than 20 billion in acquisitions year to date. And that is a great thing because that is money coming back into the ecosystem. And that money coming back into the ecosystem will eventually result in more startups, LPs getting money back, VCs getting money back, new funds being raised. It's part of what makes the Valley go. We had steady M&A activity last year. Probably, no, 85, about 86% of it last year was undisclosed. And by undisclosed, I simply mean amount undisclosed. For whatever the reason, the acquirers and the acquired companies choose not to tell you what the price was, if there was even a price. Some of these are, they have no alternative. They can't raise money. They raised in 21, 22, and their only choice now, since they can't raise again, is to be acquired or shut down. We're still seeing a lot of that in 2025, but we're seeing more in the way of large acquisitions. And that is just a good thing.
If I may,
The
before we
bad
go
thing, and
further,
it's
Don,
continuing.
Don, if I may interrupt for a second for the question.
Yes.
It goes back 2 slides, but it goes back to what you were talking about with Claude Code and how that's emerging. I think Anthropic is an interesting company because they're not only, in the OS sort of sphere and becoming a platform, but I was talking with a colleague who's looking at this from the perspective of where are the picks and shovels in this business. And of course, we can look at Cursor and some of those other ones. And I still believe if we can find that, that's the greatest opportunity in all of this. Certainly electricity, power plants, nuclear power, all the rest of it are parts of that. But that's
Yep.
at a scale unachievable by startups entering this space. So I was just curious as to what you're seeing in regards to who are the picks and shovels. And is it even that Anthropic is not only the OS and the platform, but also with Claude Code, part of the picks and shovels business, and that being an interesting way that it's being integrated?
Well, by picks and shovels, I think you mean the basic tools of the trade here, right?
Yes, absolutely. Yes.
Yeah, I would agree with you. They're absolutely there. And I would make the case that OpenAI maybe one step up, not that low, but I wouldn't be surprised to see OpenAI do exactly the same thing in the way of focusing on coding. They have the immense number of projects going on right now, and we only hear about the ones that they decide are going to be money makers and they put out there. You know, even again, sidebar, we're still seeing new companies being minted up with coding in mind. You know, doing what they perceive as a better job of providing coding support than, you know, whether it's Cursor, Claude. They think they see an area in which they can excel. I would say we've seen three, like 4 of those in the last month. So it is by no means an area in which no one sees opportunity.
And if I may, one more adjacent but related to this, because you were talking about OpenAI's efforts in this direction, and certainly they need to do more. And they tried to buy, a couple of the
Right.
Cursor or whatever. But I was speaking with the senior leadership of a couple of Big Fours, and OpenAI's decision to do the consulting practice themselves, as opposed to partner and develop a stronger ecosystem. Now, that doesn't entirely rule it out, but it does mean they're competing. And if we look back to, like AT&T was ready to buy my company in the mid 90s, and
Yeah.
they decided they didn't want to go in the local content business because it would compete with the content running through their pipes. Right. And so I'm just wondering about the competitive dynamics of OpenAI going into the consulting practice as opposed to supporting a broader ecosystem, and how you look at that in terms of a signal for their future potential or possibly risk.
I see them as being willing to compete with anyone, anywhere, and not really caring about the ecosystem from that perspective, Chris.
Yeah. Great. Thank you.
Yeah. Um, it'll be interesting to see where they go next, and how they come out with some of these projects they've talked about, vis-a-vis the, LinkedIn competitor, and a couple others that I've heard mentioned but not seen any details on. Okay, so I just want to do a short rant on this. One of the reasons we did not see more in the way of M&A last year, in an area we should have, we should have seen the big companies buying some of the little companies. That is typically the way that the Valley has grown. When you get new technology, you don't necessarily build it yourself, particularly if you're a Google or a Microsoft or Amazon. You buy the companies that are out there in the lead in doing it. Well, unfortunately, in the realm of AI, we got into this reverse acquihire thing. And this month, NVIDIA joined the bunch. They, in Fabrica, they wanted in Fabrica, which makes a lot of sense for them. And Fabrica provides ways of networking chips together. The logic behind the acquisition made lots of sense, but the way they did it is terrible for the Valley and the ecosystem. Essentially, in most of these cases, what they're doing is they're simply buying the founders. Whether they directly hire them, they pay them to come over, they compensate, a combined package, but the founders leave the company. The company gets something for the technology. In other words, NVIDIA licenses and Fabrica's technology so they can use it. They take their founders, they take the top researchers. What's left is basically, saying it's a shell may be overstating it, but what is left is going to have to pivot because they're going to be competing with a much larger entity doing exactly what they were doing. And all of their key talent doing it against them. And in most of these cases, the remaining employees are getting nothing out of the deal. They're left with options that are essentially worthless. So Microsoft did this, Amazon's done this a couple of times, Google's done it, Facebook did it on a grand scale with Scale AI, and now NVIDIA. So this is just a bad thing for the system. Investors don't like it because, not in all cases, but in many cases, they certainly do not get the return they were expecting, and in some cases, they're just plain old cut out. Not good. As a matter of fact, I was at a meeting, a lunch a couple days ago, and a couple of the investors there were commenting on the fact that they are trying now to get clauses into their investing agreements that say that the founders agree not to do this. And depending on how much leverage the founder has, obviously they push back or they accept it. But this has become a problem in the Valley. Yes, IPO market. Just a sidebar real quick before we get to the IPO market. Since we're talking about the Valley and the whole ecosystem, we have seen so much more money coming into the Valley in 24 and continuing and increasing in 25, that two things have happened. The first thing is that the amount of dry powder out there, which back in 23 it was an all-time high, something along the lines of 330 billion. That's money that was raised by VCs and not invested. They were just holding it. Didn't, for whatever the reason, they were not investing. And there were funds that were raised in 21 that no dollars had gone out on. So 24, 25, we start to see that change. And it's now changed to the extent that dry powder, again, these are estimates and they're typically trailing estimates because you're not going to get that information until after the fact, obviously. But it's down to around 280 billion. Now, the other thing that goes along with that is that money being raised by VCs is also down. For most VCs right now, it is tough to raise a fund. That was a common theme at the luncheon I was at. Easily 2/3 of the people around the table raised their hands when asked who's raising. And all of them agreed that it's the toughest raise they've ever done. So for the vast number of VCs, that's going to stay tough until we get more money back into the system, because the money back into the system goes to the LPs. And what is 100% true on the LP side is they're going to not want to pony up for a new fund if they haven't gotten back some money from the first fund. So distributions, if you will, to those LPs are absolutely key to VCs being able to raise new funds. And that goes back to the rise of companies being able to do secondaries, the secondary market, and people who are willing to buy shares, not in a direct round, but after the fact with the company's agreement. Secondaries have just exploded. They've doubled since 22. And that also goes towards another thing we'll talk about, which is companies choosing to stay private longer. But the IPO market is probably the biggest key in the amount of money, percentage of money coming back into the system to, again, to go out to LPs, to go back to the VCs, to, if you will, reinvigorate fundraising. And thank God this year we have seen a number of successful IPOs. And by successful, I mean they came out and they did a reasonable valuation up from where they were previously. That's not to say they exceeded their max valuation ever, and I'll talk about that in a minute, but the IPOs around AI have largely been very successful. The current pricing on all these are actually, this is H2, they've all gone up since the end of June. So the IPO market appears to be hungry for and welcoming AI-related IPOs. And we hope to see more of that, because that is real key to the health of the Valley ecosystem and startups continuing to be launched, funded, and VCs continuing to put money in. The two at the bottom, CoreWeave and Circle, I throw in there, even though they're not Silicon Valley companies, simply because CoreWeave is one of the, I'll call them base AI companies. They're tied into Microsoft, they're tied into OpenAI, they're, of course, tied tightly into NVIDIA. And the last I heard, they had sold all of their available computing for the next 3 years to one of those entities. And Circle, of course, is crypto. And crypto is the other area we've seen take off. Now, this is this year. We did not see that much of crypto last year, except for November, December, after the election, of course. But crypto has been very active this year, falling into the fintech arena. And Circle came out, and it has fluctuated up and down, but it is up and staying there. No, wrong way. There we go. So this is what I meant by the not necessarily their highest valuation ever. The 2021 valuations still remain as a high point for most companies. And it's a reason that many of the larger companies, when they're doing a later stage, are doing down rounds. And these IPOs, they're actually, you can call them a down round IPO, because the valuation they got, while it was good and up from just before the IPO, it was under what they were at in 2021. Come on. Okay. This is a phenomenon that has, we believe it's happened because of the history since 2021. The companies that had raised big money in 2021 did not need to go back for more. They saw there was no possibility for an IPO. The IPO market was dead from probably the mid-22 until just this year. And they hunkered down and have stayed private. There has been a market for late stage rounds. So used to be you did a B, a C, a D, maybe an E, and you did your IPO. Not anymore. It is the unusual week where we don't see a multiple D and E rounds. And Databricks, the first ever Series K that we've seen. So this, we do not believe, is going to change, certainly not in the short run. We'll see where we end up in the midterm. Another thing that's driving this, of course, is they get no pressure from their employees to do an IPO, because the employees are getting liquidity from these secondary sales. Every single one of the multi-billion valuation companies, the Databricks, and of course OpenAI and Stripe, Carta, they all have provided their employees with a secondary sale and allowed them to sell some shares. You know, they put some brackets around there. You have to have 2 years. You can only sell 40%, but they all do it. And their up rounds, they've gotten internal valuations that increase their valuation periodically. So the employees are happy to sell, get some money, And they're not pressuring now then for the company to do an IPO. And of course, on the other side of that equation is the secondary sales let investors give their LPs back some money. So whereas Precursor Ventures is a great example. They are at early stage VC. They typically have held on and not gone out and sold their shares before a significant M&A event. Charles Hudson was talking at a conference about a month and a half ago and said that after pressure from his LPs, he was surprised to find that he could actually sell through secondaries and still get a 3x return, which is typically the VC target. You want a 3x return on your fund. So this has changed the whole equation. VC funds used to be 10 years. Companies aren't necessarily going public in 10 years or cashing out in 10 years. So we see funds doing secondaries, we see companies doing secondaries. And all in all, it has certainly changed the way the Valley works. Given our situation and the drought, if you will, for M&A and IPO for a couple of years here, it was a logical outcome. Probably not going to change. Now, we don't expect the IPO market to come back quickly. Probably of course, when the government opens again, we will see some people coming back to the public markets. There's probably 6, 7 tech companies who have announced and filed and announced in the last couple of months, but not made it out. We would not be surprised to see, again, given that the government opens up before the end of November, October and November IPOs. But again, it's maybe the tens of companies, not the hundreds. NASDAQ still has more than 100 companies that have filed publicly or confidentially for IPO, but there is no mandate. There's no reason that they need to move ahead before they want to. That figure at the top, the 2.75 trillion, never had that much in value in private companies that are venture funded before. It's a new high. Let's see, what else did I? Oh. Okay, one thing I did not put a slide on, and I just want to mention, AI infrastructure. Just a couple of quick words on it. Keep your eyes on this because just in the last month, the number of announcements of outright investments and commitments is just off the charts. You know, we had OpenAI committing to 100 billion in AI infrastructure this year. They cut a deal with Oracle for 300 billion in what is going to be data center constructions. We had NVIDIA come out with the biggest announcement this month, and that was that they would invest 100 billion in OpenAI in tranches, 10, 20 billion at a time. All of this to go towards data centers, to go towards, again, AI infrastructure. Their goal is to add in 10 gigawatts with that 100 billions. And 10 gigawatts, we're talking the equivalent output of multiple nuclear power plants here. It is a lot of infrastructure. There are economists who have and will tell you that quite frankly, the AI infrastructure spending is propping up our economy right now, where consumer spending has dropped off, AI infrastructure has skyrocketed. We're on a trajectory, according to Bain, to put in 100 plus gigawatts before 2030. And that's just a mind-boggling figure. We will have to invest around 500 billion a year to do that. And again, according to Bain, to justify that, we need about 2 trillion in AI revenue. Their thought is that we're going to end up about 800 million short. So we shall see what happens there. I said 800 million, 800 billion short. AI infrastructure is going to keep us all busy from the perspective of money coming in, money going out, who's coming through on these commitments. So stay tuned. Quick roundup on LinkSV, all of what we do, business intelligence on the startup ecosystem. We are totally focused on Northern California, Silicon Valley in particular. Although as Silicon Valley has grown, it now encompasses a lot of Northern California. We do go as far north as Sacramento and occasionally to Eureka, very occasionally. The Pulse of the Valley is our weekday newsletter. We cover startup fundings, exits, people, investor funds, and both new investors as well as new funds. It's backed up by a database that we have been building for 25 plus years, lots of deep activity. And on the give back to startup side of thing, we make that available to startups for fundraising at a $7 a month value or price. We do everything we can to support startups who are trying to raise money, particularly those who are pre-seed and seed, because that's the toughest thing to get going. And we do a once a month webinar, Intro to LinkSV and to fundraising. It'll be October 22nd this year, or this month. And with that, I think I'm going to turn this back over to David. I'm going to stop
Thank
share.
you, Dawn. I'm gonna put us right into breakout rooms because we're kind of running.
Yeah, I know. I took a long time today. Sorry, David.
That's all good, and we'll be back in a minute before. Hmm.